Welcome to AXR Investments, weekly market update, March 17th, 2025. Let's dive straight in. So what's going on with the market? The stock market took a hit recently, dropping about 10% since hitting record highs in mid-February. This drop is what experts call a correction. And while it feels alarming, it's actually a normal part of the market cycle. The main reason? Uncertainty over tariffs and trade policies. With ongoing changes in U.S. trade policies under the Trump administration, businesses and investors are left unsure about the future. This uncertainty has led many large institutional investors to pull back, creating volatility. So, why are tariffs a big deal? Tariffs impact the cost of goods, affecting everything from raw materials to finished products. While the Trump administration has emphasized that these policies are aimed at protecting American industries and reducing reliance on foreign goods, the back and forth on tariff decisions had made it difficult for businesses to plan ahead. This uncertainty makes it hard for investors to know whether to buy the dip or wait it out. Hedge funds and big institutional investors are playing it safe, but individual investors, like many of us, have continued buying during this period. Corrections happen, and they're normal. Market corrections happen more often than people realize. Since 1950, the S&P 500 has averaged a 13.7% dip each year, but most of the time, 73% of the years, the market still ends up in positive territory. In fact, years with a 10 to 20% drop have historically ended with an average gain of 8.4%. So while it's nerve-wracking now, history suggests that these downturns often set the stage for future gains. Are we close to a market bottom? It's hard to predict exactly when the market will turn around, but there are signs to watch for. 1. Fewer than 10% of stocks trading above their short-term moving averages. 2. A higher VIX, the fear gauge, above 30, signaling that fear may be peaking. 3. A shift in market leadership and defensive stocks like utilities to more growth-focused sectors like tech. Why staying invested matters. History shows that missing the best days in the market can drastically reduce long-term returns. After a correction, the market tends to bounce back strongly, with average gains of 13.1% within 3 months and nearly 30% over a year. Trying to time the market is risky. Missing just the top 1 or 2 days of the year can cut returns in half. Looking ahead, caution but opportunity. While things look shaky now, LPL Financial is taking a neutral stance on stocks while waiting for clearer signals. Until trade policies become more predictable and earnings forecasts stabilize, staying balanced and diversified remains key. Opportunities and volatility. Some of the best buying opportunities happen during market corrections, so staying invested and thinking long-term can really pay off. The bottom line. The market's recent turbulence is a reminder that investing isn't always smooth sailing. But history suggests that sticking to your plan and staying invested during these dips is often the best strategy. As Warren Buffett famously said, be fearful when others are greedy and be greedy when others are fearful. Thank you for joining us and see you next week. Be sure to like, subscribe, and share. Thank you very much.